Hello and welcome to another weekly financial update from RTS Financial Planning. I'm Carl Roberts, Chartered Financial Planner here, and this is where we look at some of the stories that have happened in the world of finance this week and also discuss some of the subjects that our investment committee are looking at as part of our RTS investment strategy. So it's been a bumpy ride for stock markets this week, particularly in the UK and Europe, and this has been as a result of two main issues. Firstly, we saw a new banking scandal as leaked suspicious activity reports appeared to show that some banks were involved in handling money laundering transactions from criminals. So money laundering is where criminals will use money they receive from illegal activities and try to push it through the banks and make it look legitimate. What's worrying is that some of these banks appear to carry on with these transactions even after suspicions were raised. So HSBC appeared to be at the forefront of these allegations, and their stock price was hit significantly to a 25-year low. Other banks have suffered too in terms of share price falls, banks like Lloyds for example. Investors are now starting to worry that there'll be future fines on the way for banks again, and also increased regulatory costs to deal with the fallout. The other big issue of the week was the continued rise in coronavirus cases. Earlier in the week, the UK put their two chief medical scientific advisors up in front of the cameras, where they painted a gloomy picture of the pathway that we are on. They were predicting increased hospitalisations and increased deaths if we don't change course. So this has led to the government announce a range of new measures to combat the virus, and of course this is going to have an impact on the economy. And it caught the stock market out slightly, and this will always cause big swings when the stock market is caught out. Obviously, for some time the stock market has been doing quite well and has been predicting an economic recovery. It's seen the virus come down and not be such a big issue. But obviously in recent weeks case numbers have been going up across Europe, and now countries are starting to put new measures back in place, which again is going to impact the economy. So investors now have to readjust their calculations and try to predict the future again. But the government is walking a delicate tightrope here. Obviously, the more strict the measures, the more damaging the impact's going to be on the economy. But more loose and relaxed the measures are, the more that could affect people's personal health. But remember, volatility is always part of investing. We always expect it year on year, even if we weren't going through a pandemic, we'd expect some sort of volatility in the stock markets every year. But now is not the time to panic. We must stick to our investment plans and our goals, unless something has changed in your personal lifestyle and you need to readjust that plan. Remember, declines are temporary, the advance is permanent. In the short term, the stock market will be volatile, but over the long term, you should see significant gains on your investment. So I hope you found that useful. That wraps up this week's update. If you have any questions or any comments you wish to make, please leave a comment below in the YouTube comments field, and we'll happily answer any questions you've got. Until next time, take care.